By the way, there's a company on the chopping block right now. They aren't gone, but they're being examined right now. Two others have been thrown out. Was it thrown out of bed? I don't know, but I mean, two others are gone. There's another one right now they're looking at, okay? So as a person selling that, I love that. But as a person with his own money in there, I love that, okay? Well, I didn't understand all that stuff. The third issue I had was market timing. We had competed, and I'm going to show you some stuff. We had competed with some when we were doing retail, where they were just traded. The computer traded the models, and I don't know how it all worked. But here's what I saw on the person's statements. There were multiple times in the same quarter where they were buying and selling the same stock or the same fund. And the majority of the time, the buy price was higher than the sell price. So they'd buy it, ride it a while, sell it, wait a while, buy it again the same quarter multiple times. And it's like, well, if that's what a managed account is, no thank you. I don't need any of that. I mean, I can take money from that like easy. Well, what I learned was that isn't how they all worked. But see, I didn't have any knowledge. I just managed account. They're all the same, right? It's like saying cars are all the same, right? But I didn't know that. So when I dug deeper, I found out, wow, okay. So here's actually an example. This is actually from this person's statement. Okay, now this is 2011, but this is when I was learning this stuff going, managed accounts are terrible. On the second quarter statement, the market was going up pretty strong. This was what their portfolio looked like. They were early 40s. Their objective was aggressive. I looked at that and I'm like, well, there's exactly zero chance that this can perform. This is terrible. I got their third quarter statement from them, okay? And in their third quarter statement, the market was going down. The market was taking a dump. And the portfolio sold all the stocks and went all into cash and bonds when the market was going down. Well, folks, you and I understand you buy when the market's going down. You don't sell when the market's going down. You got somebody 20 plus years from their retirement goal and they want to be aggressive, and this is their portfolio? Well, I thought, no way. But again, what I learned was everything doesn't work the same. Next thing, right, is additional charges, right? We found models, because again, we used to compete and take money from these things, right? Well, they were not very good programs, right? But we found models where they had additional charges for rebalancing, and they charged the client fees on the internal trading in the portfolio, plus the program fee. And none of them were disclosing the fund charges. They were only showing the advisor fee. Well, guess what? What I learned, we don't do that, right? We believe in full disclosure, and we don't charge clients for extra stuff. The total program fee pays the investment companies, Primerica, us. It covers everything there is. So when we move, I've got 7 appointments this afternoon. It's a good day. And I'll be meeting with people making adjustment things in their portfolios. And there's no charges to the client to do that. That's customer service. Excuse me. That's part of taking care of the client. So the fifth thing, right, is we ran into things, what I call representative managed ones. And that means the person like me, the person like you was doing everything. I'm gonna actually show you an example, right? But I know there's no way that a person can do the research, make the trades, buy or sell the stocks, meet with clients, develop new clients, and manage their current book of business. Nobody is that good. There's zero chance nobody is that good, okay? So I thought, well, if that's what they are, well, a mutual fund was better because I've got the manager of the fund doing everything, and I can just adjust the portfolios when I need to. That's what I thought. What I discovered was this: that's not how we do it. We leave the research to the experts in their field, right? We got some companies in our program that have over $1 trillion in assets. my research department can't compete with that. Okay, Kurt's research department. It's not possible. So we let the experts do their thing. Hey folks, our job, develop clients, provide great customer service. That's our job. Okay? That's what we're supposed to do. We pay the pros to do that. Here's one of the reasons. Here's a representative manager one that we ran into early in the managed account business, right? We were just getting our feet wet right now in 2012. This is actually a lacrosse salesperson, sold this portfolio. During the nearly 7 years the client had this, they averaged 1.8% return net. You can see what T-bills, CDs, what everything else did. I thought, well, if that's a representative managed account, why would you pay somebody for that? That's terrible. Now, again, one person, you or I, either one person cannot do everything. So we leave it to the experts, okay? So these are the things that I found I really like about our managed account program, okay? Hey, I'm sure we're gonna have some Q&A time. There was supposed to be a market update today, and it got skipped. So I didn't plan a full hour, so I'm sure we're gonna have some Q&A time, all right? So these are the things that I like about our program, right? We have really competitive fees, and they're fully disclosed. There's no hiding. I hope the recruiter doesn't find out about that. We tell everything. Well, I like that. I want to be moral. I want to look people in the eye and go, hey, here's what the charges are. Here's what it is, okay? So that was attractive to me. The second thing that's super attractive is we've got excellent SMA, ETF, and mutual fund choices. And you and I can build a UMA, a unified managed account, and build our own portfolios if we want to, with the managers that we think are the best, the ones that we want to work with. Well, I think that is really cool. It's not a boilerplate, right? It's not a one-size-fits-all. A lot of the people we compete with, it's a one-size-fits-all. Everybody in this group gets the same thing. Okay, well, I like customizing it for people, okay? Third thing is we have fully vested options. I am not a market timing person, okay? I am not a tactical person. That doesn't mean tactical's wrong if you like it. I'm not saying that. I'm not. So I like stuff that's not in and out of the market, and I want to be in, okay? And we have tactical choices also for people that like that. But we have options where you and I as a representative can put together the program that we feel is the best, okay? Fourth thing, there are no additional charges, okay? Our rebalancing is covered, right? Any of the trades the managers make are covered. So if we change companies, no problem. If we change investment objective, no problem. The client's not getting, because the problem is when there's fees charged when you make adjustments, now the client can wonder, well, is this really a good idea? Or does Kurt need to make some more money, so he's moving my money around and I don't even know if it's a good idea or not. I love the fact we are paid based upon AUM. If the AUM goes up, the client's happy, I'm happy, Primerica's happy, investment companies are happy. If the AUM goes down, we're all unhappy. I love that approach. It's a totally moral, upfront, fully disclosed approach. And I love the fact that our programs are company or team managed. I'm not managing the individual people. We've got a team doing that. And we like to use a lot of options that are team managed, right? For example, AGF, right? Tony just retired, okay? Well, but he's been working with the same team for a long time, and they've all been working hand in hand. So when one person leaves, it's not like, oh my gosh, now what? No, I mean, they all know what everybody's doing. They've all watched him work. So I love that concept. And I love the fact that the companies are doing their research on what they're doing, and then this company is doing their research on what they're doing. They're not believing what other people tell them. They're in, okay? So key differences that we have, right? You and I are independent. We run our own business, okay? So we're not obligated to any specific manager. We can go where we want to go. Second thing is objective, right? We talked about this. We're paid on advice. We're not paid on which company we put you in. We're paid the same no matter what company it is in the managed account platform. So that's off the table. The objective is what is the right thing for the client. Third thing, right? We are not proprietary. There are some companies out there that sell their own programs, their own funds they run inside the managed account portfolio. Well, that's terrible, okay? Because if it's a proprietary model, if Darren Rutherford is the CEO of the company and I'm running a fund for the company and Darren's my boss, we work for the same company. And if I'm doing a kind of a mediocre job, our clients are not doing real good, but our salespeople are selling the heck out of the fund I represent. So there's lots of AUM coming in. Darren's making lots of money for stockholders and himself. When is Darren going to fire me? That would be never. So our clients are paying the price for my ineptness because Darren and stockholders are doing well. Well, that's terrible. But if I'm with a different company and Darren's the CEO, he has no obligation to me. He has an obligation to his clients. Fire my butt and put somebody else in that does a better job. Well, I like that approach, how we do things. And last, we talked about rep as portfolio manager. We don't believe that. We don't believe that. If I'm the manager running the portfolio and it's doing poorly, when do I fire me? Well, that would be never also. So, but in our program, right, where we're not the manager of the funds, they're running the funds. Fiducian in the Primary Investment Committee, they do their job, okay? So let's talk about attributes, okay, to our program, okay? Number one, with managed accounts, what I learned was the ongoing monitoring of funds in the client service is really important, okay? Gang, if you're not talking to your clients, wow, there is so much money out there. Your clients just want to know who to trust. If you provide great customer service, folks, your phone's going to burn up off the hook. I'm not kidding you. Okay, we'll talk about that in a little bit. I'm not teasing. Okay, so what I call a proactive versus a reactive approach. Okay, so all of us have clients when we look at our clients' portfolios, and maybe like one of the people I'm going to meet with today, I think they should make an adjustment. If they're in retail mutual funds, minimize the bottom just a hair. That's better for the client long term. The next thing, right, is portfolio rebalancing. We've talked about that, I believe, recently, how the 3 different ways to do the portfolio rebalancing. Well, that's awesome. And they do it when they should, not when the calendar says they should. The most basic of the rebalancing ones, which just makes complete sense and the clients love it, right? Every time money goes into the portfolio, it buys the undervalued sector. It's within tolerance, but it's a little low. So every time money goes in, they buy. Every time money comes out, they sell the upper valued sector. It's within tolerance, but it's a little high. Well, we're buying low and selling high automatically for the client every time something happens. Well, that's a no-brainer. That's spectacular, right? Next thing is downside monitoring. I'm going to show you an actual example, okay? Downside monitoring. Okay, there are no guarantees in the managed accounts, but we have proof. If you're building a great allocated, diversified portfolio, we have proof they minimize the downside, especially compared to retail, okay? Now, this is a client, okay? Actually, I'll stop here a second. This is a client that was a pretty large client. They had dropped $1.3 million with us a long time ago. I had them in retail, okay? About 800 and some in retail, and they had some in a variable annuity. So this client, I told them about managed accounts, And he said, well, do I got to pay the fee even if it goes down in value? And I said, yeah, they charge a fee regardless of what's happening. He goes, well, I don't know how I feel about paying a fee. You know, I'm going to lose money. Or if it goes down. I said, well, how about if it went down less net after the fees? Would that be worthwhile then? So there's like 850,000 or something in this portfolio. We put 500,000 in managed accounts. Okay, we did this in the first part of August in 2011. I'm going to show you actual statements, okay? Because I was monitoring this stuff like crazy, okay? So on the left is his retail. They made us take all the names of everything on retail, so we didn't make the retail company unhappy. So in the next 30 days, that retail portfolio went down by 6.2%. The managed, which is nothing like today, trust me, went down by 1.6. Same objective, moderate growth, moderate growth. Over the next 60 days, the retail went down 10.8%. The managed went down 4%. I called him and told him that, and he said, put everything in managed. And that's where it's been since, okay? He is happy as a pig in slop, I'm telling you, okay? So we have proof, and I'll show you some other stuff also. We have proof they minimize the downside, okay? Well, folks, I'm telling you, you don't lose people if the market did 28 and you do 26. You lose people at negative 30. That's where you lose clients, all right? So by minimizing the downside, it makes a gargantuan difference in return. Example, okay? Getting out of the hole you just did. Most people think if they go down 20, they just have to go up 20 to get back to even again. That's what they think. But that's not true. If you got 100 grand and you go down by 20, you have 80. If 80 goes up by 20, you have 96. You're not home yet. So, example, 2008, the market goes down nearly 40%. You got to have a positive 67% year just to get back to even, okay? What if that year you would have only gone down 25%? Well, now you need a positive 33 year just to get back to even. Now, I'm not telling the clients positive 33 years are easy to find, but I am telling the clients a positive 33 year is much easier to find than a positive 67 year. That is factual, okay? So minimizing the downside is huge. This is even a bigger example of that, minimizing the downside, okay? So this is a $100,000 portfolio. The portfolio one is a more exciting or volatile, up and down, like the stock market, okay? Portfolio two is a little more mundane, a little bit more boring, okay? Not quite as exciting. Example, portfolio one, the first 2 years, big opening, big money. Portfolio two, little bit, not as exciting, okay? Portfolio one, 3 bad years in a row. Portfolio two, bad, but not as bad. And then portfolio one, big finish. Portfolio two, not quite as big a finish. Which one, Mr. and Mrs. Client, which 7% do you want? The really exciting up and down 7%, or the little bit more mundane, a little bit more boring 7%? What do you think the answer is 100% of the time? The one with the most money in, okay? So gang, a story to teach that, right, to the clients, right? So, let's see. Hey, Darren, turn your microphone on. So if I'm talking to Darren, okay? So let's say, now I usually ask the husband and wife, hey, who pays more attention to the grades in school? Doesn't matter, I'm gonna talk to Darren here, right? So Darren, remember back like when your kids were in school, if they were getting all A's and they got an F on the final, what did that do to their grade point?
That brought it down.
Yeah, a little bit or a lot on the final?
A lot.
Yeah, a lot. Now, what if they were getting all B's and they got a C on the final? Did that hurt as much?
Not as much.
Yeah, exactly. So, Darren, when I'm running your all's money, I'm trying to get B's and C's. I want to make money in the good years and not give it all back in the bad years. Does that seem like that makes sense to you?
Yep.
Thank you, Darren. So that's a great story to teach, minimizing up and down a little bit. Okay, that's a great story to teach that. And gang, I've been doing managed accounts. It took me a while, but I've been doing managed accounts since 2011, and we have seen it. Now that was really weird for me because I was used to like, man, got 34% last year. Woo! Okay. Sometimes managed accounts don't do that. But actually what we talked about, again, about I think it was like the last month or something, I showed you real numbers. They actually were the best performing products last year. But they don't have to be. If they minimize the bottom, they don't have to be. Let me give you real live, hands-on, okay? Real live, hands-on. 2022, for most of you, that if you were around then, you know that was a pretty ugly year, okay? If your portfolio had the word growth in it, it was ugly, okay? So in 2022, you can see the date, all this was researched. In 2022, excuse me, the multi-cap growth sector of the economy, this is the peer group or the index, was negative 32.9. Couple retail funds we use were negative 33 and negative 40. Okay. The Lockwood U.S. Aggressive Equity, which is now called the BNY US 100, right, is a multi-cap growth portfolio. They were negative 19.2. Folks, not that and that's net, by the way. Now, not that I'm excited the client was negative 19.2, but have a talk with the client that's negative 19 or a talk with the client that's negative 40 and see which one's more comfortable. Okay, the large cap growth sector, the large cap growth index was negative 31.5 that year. Couple large cap growth funds, right? Negative 33, negative 39. The AGF US large growth was negative 13.4 that year. Again, I know I'm being repetitive, but most of you, like I was running around, I was here in 2008 when they had the greatest downturn since the Great Depression. By the way, we had our record volume money coming in that year because we teach clients concepts. We don't focus on rate of return. So you got a client that's negative 13, they're not happy. But when you show them they would have been negative 30 plus, negative 13 is pretty good, okay? The S&P 500 is negative 18.1 that year, okay? ClearBridge Appreciation, negative 7. DivStrat Mutual Fund at NAV, negative 8.4. The DivStrat SMA Net, negative 7. Okay? There's a pretty interesting viewpoint there on the SMA versus the retail mutual fund. Now, the bond index, the Barclays Aggregate Bond was negative 13 that year. That's pretty ugly, okay? Couple of big bond funds, negative 16, negative 11. I no longer use the Sage Multi-Asset Income, but I was that year, so I'm showing that was negative 11.5. So in all those asset classes, the clients fared substantially better. Now, what about UMAs? What about we build a UMA, okay? So the aggressive growth UMA that year was Lockwood U.S. Aggressive Equity, ClearBridge Dividend Strategy, and AGF U.S. Large Growth. 100% equity portfolio was negative 13. What was the bond market? Negative 13. Okay. A growth UMA, Lockwood U.S. Aggressive Equity, ClearBridge Dividend Strategy, Sage Multi-Asset Income, negative 12.8. A portfolio that was 68% equities was down less than bonds. And a moderate growth portfolio, I misspoke, 84% stocks. A moderate growth portfolio, 68% stocks, 32 bonds, was down less than the bond market. And our program today is like gargantuan superior to what it was then. Gargantuan, okay? Now, let's look. Bring these in. Come on in. You can do it. I know you can do it. I know you can do it. Okay. Clients like the fact, the peace of mind that their account is managed on a daily basis. I'm telling you, your people worry about fees. It's not an issue. When people see adjustments happening in their portfolio, you know what they feel like? They're taking care of my money. They're doing stuff. They're making something good happen. People love that, okay? People love the fact how the compensation program is aligned with the investment plan, okay? So here's how I teach that to people. Hey, Isaac, turn your mic on. This is how I talk to clients like that, right? So I talk about that. So, Isaac, this is what that means. Okay, the total program fee that you're charged on your portfolio, I'm paid a portion of that. Primerica's paid a portion of that. The investment companies are paid a portion of that. So this is what that means. If your account balance goes up, you have more money, I make more money, Primerica makes more money, and the investment companies make more money. Now, Isaac, if your portfolio goes down, you have less money, I make less money, Primerica makes less money, the investment companies make less money. Isaac, that doesn't mean it can't go down, but can you see there's a vested interest? You and I are on the same page. We want your portfolio to grow. You see it's important to me that you do well?
Yeah, I like that.
Okay. And thank you, Isaac. And you know what? That's how you talk to people and they go, well, yeah, that makes sense. I like that. Whereas in retail, okay, I just get paid when you put money in. If it goes good or bad, I still got paid. You don't get paid put money in managed. You get paid on the AUM, okay? People like the accountability and the transparency. The fact that they get a statement every month, electronic or paper, whatever they want, and it shows everything that happened during that month. All the trading, all the adjustments, what you started with, the fees you were charged, what you ended with. It's all very open and transparent, okay? So here's the closing question that we use when we're for our power close, our high pressure, aggressive power close. Mr. and Mrs. Client, how would you like your investments handled from today forward? Your current strategy or the lifetime investment program? That's how we ask. And you know what they say 99.9999% of the time? Lifetime investment.
I like the lifetime.
Yeah, exactly. That's what they say every time, okay? I mean, I said 99.9999 to make it safe. Folks, we don't believe in pressuring people. We don't believe in hammering people. We don't steer them to only one thing. I just believe it's a superior product. I believe that so much. This is where my wife and I's own money is. This is where my mother's own money is. This is where my father, before he died, this is where my mother-in-law, before she died, that's where their money is, okay? And folks, our mother-in-law lived with us. My mother-in-law lived with us till she died. You know how dangerous that is if you do a bad job investing? Woo, okay? So, here's an article I've shown a zillion times, okay? Here's a zillion one. People prefer, okay, asset-based or retainer or hourly versus commission. People prefer it. Because when it's a commission, and I use some other articles again, I think last month or earlier this month or something to show it, differences between the two and third-party articles, okay? People prefer it because I'm in the same page they're on. You do well, I do well, you do bad, I do bad. Not, I get paid regardless. So, if you've got a current book of business, okay, excuse me, here's what I would do. I would sort through, and I would sort by birth date. Hey gang, at the end of 2011, Primerica had 13 million AUM and managed. 10 of that million, I was the advisor on. They brought me in and did some filming. And because this was all really new, okay, and there were other fees involved, they brought me into the TV studio and they sat me in a room with a bunch of attorneys And I'm like, okay. And they wanted to know, so how are you finding these clients? I said, I'm going through my current book of business and I'm searching by birth date and I'm talking to the oldest clients first. And they said, you mean by account size and your biggest clients, right? I said, no. I'm talking to them because I think they provide better defense. So I'm talking to the oldest people first. And that surprised them. But I believe that's a great way to start. So I would talk to my most mature clients, bring them in, talk to them. So here would be the phone call you could make, okay? So now that I have the staff do this, I don't do this, right? So, ring the client's answers. Hi, this is Audra Keeney from Kurt Poole's office. Kurt was reviewing their portfolio and he thought with the market near an all-time high, it might be a good time to consider making some adjustments to try to stabilize your portfolio a little bit. Would this week or next week be better? Same phone call if the market's down the toilet. Hi, Mr. and Mrs. Client, this is Audra Keeney with Kurt Poole's office in Primerica. Kurt was reviewing your portfolio, and with the market pretty crazy and volatile right now, he thought it might be a good time to get together and make some carburetor adjustments to consider stabilizing your portfolio a little bit. Would this week or next week be better? What percentage of the clients do you think come in with that phone call? That would be 100%. Okay? That would be 100%. And then I just show them, hey, listen, I've got something I want to share with you guys. We can keep your current program, make some carburetor adjustments, but I want to show you this, and I want you to decide which one you feel is a better strategy for you guys. And then I teach them about managed accounts. Now, if the client has paid $500 or more in dealer allowance in the last 12 months or the last 13 to 24 months, they have a fee forgiveness program that makes sure the client is treated correctly. Okay? It can last up to 24 months and it could be shorter than that. Okay? So I love it that we're morally treating the clients correctly also. All right? So provide great customer service. Okay? If you give your clients great customer service over time, you've got unlimited referrals, happy, satisfied clients. Folks, I've not made a soliciting phone call in over 25 years. And people call our office to meet with us every week to invest money, do a rollover, something like that. So great client service over time, your current clients will tell everybody about you. Poor client service over time, they take their money elsewhere, or they don't tell anybody anything good about you. So I know there's some questions. I'm gonna give you one or two quick points, and we're gonna do some Q&A. All right. So, for example, I see Javier's got a question. Isaac is running that, not me, but I'm just gonna use his name. Okay. So if Javier is a client of mine, he and his wife Vanessa, and they're really happy, and things are going well, and they're at lunch. He's at lunch tomorrow at work, and his friend. They're at lunch talking about, they got their statements, and his friend's like, man, we don't understand what's going on. We get our statement, we can't read it. All I know is it doesn't seem like it ever goes up. When he talked to our current advisor, by the time he's done talking, I'm more confused than when he started. When he stops, when he takes a drink or takes a bite, Javier goes, really? Wow. Hey, we work with this guy from Primerica, Kurt, and we meet with him every year. My wife likes him. He does a good job for us. We understand what he's doing. We're on track for our retirement goal. He takes a drink. His friend goes, what's his name? What's his number? Okay. That's the life that you can live if you have happy, satisfied clients. Isaac, I turn it over to you. So we got a few minutes for Q&A.
Yeah, hey, we got just under 8 minutes, so let's just Javier, go ahead and start, man. What's your question?
Thank you so much, Kurt. I mean, you nailed it. Thank you. You were reading my mind. For the last couple of weeks, I've been questioning myself where I'm going to get so much information, something to start, learning more about it. But thank you so much. So home office basically tell you that you can move accounts from retail, but there are certain parameters.
Yeah, if you
Right.
do it, and they paid that fee, Javier, they're gonna give the client a fee forgiveness on the managed account side, so the client's not getting taken advantage of, which is what we should do.
Which means you're not getting paid either.
That's correct. That's correct.
For a period
Yeah,
of time.
until that fee forgiveness is where, because if you just got paid on the retail, well, you get paid again in the managed, that's not fair for the client. So they're gonna make it right with the client, then you'll start getting paid.
Okay. Okay, that sounds great. And does that has a time frame?
Yep.
Or let's say that the
Yep.
account has been open for, I don't know, 5 years.
Yeah, if they're packing into it, or if they put money in the last 12 months or 13 to 24 months, if they've paid more than $500 in dealer allowance in either one of those two, that's where fee forgiveness can come in. Okay? And it's not automatically 24 months, it depends. But if it's been sitting there for more than 2 years and they haven't put any money in, there's no fee forgiveness.
So the accounts that we are using, let's say a Roth IRA that they're putting money every month in a pack, does that count too?
If it's more than $500 of dealer reallowance in the last 12 months or the last 13 to 24 months,
Okay.
yeah, then it counts. Yep. Does that answer your question, sir?
Definitely. And Kurt, again, thank you so much. I mean, sometimes there's so many good themes that we are learning from you guys. By the way, thank you so much for being a trailblazer. That
It's
I
our
have
pleasure.
time. I mean, I want to listen to you, but at the same time, I want to listen to another guy.
There's a lot of good people out there.
I leave time for Anita.
Anita, go ahead. What's your question?
Hi. So thank you so much again. It's a lot of value here. New to the advising space, I opened up a couple of accounts, and I think where I'm grappling right now is like you just used a good strategy to sort by birthday. I'd heard sort by like how much they have in their account to move things from retail. But then when it comes to putting the strategy together and who should go, I find myself being a little bit uneasy and like kind of over analyzing or just like being stuck because I don't really have my own voice yet. And so how would you suggest to some of the new advisors that are moving clients from retail into managed really to have how to develop your own philosophy? Because I find myself like listening to so many different people and then I just don't have a strong voice of my own to really like feel like I can talk to the client in a confident way.
Yeah, you get paralysis by analysis after a while. And it's like, can't do anything, okay?
Right.
So if there are some managers on the platform that you already like and you're already familiar with, you probably want to lean towards them for some of the business.
Okay.
That would probably make sense. But you're going to get the SMA version, not the if they're in the appreciation. Let's say you're a Franklin person, and if they're in the dividend strategy mutual fund, if you use the dividend strategy SMA, it's not, you're not selling them the same exact thing. Although I probably wouldn't always do the same mutual fund and the same SMA. I would probably try to diversify their portfolio and do it differently. And Anita, when I look at a portfolio, I don't look at you. Now, I don't know if you're married, but I'm going to assume you are from my conversation. Is your husband named Ace?
Yeah.
Okay, perfect. You guys are superstars, okay?
That's Javi.
So I would look at your and Ace's portfolio, and I wouldn't do yours and do his. I would do the house. So I would try to diversify and use different managers. There are some people, I put some charts out. My charts and $3 get you a cup of coffee at McDonald's, okay? That could
But
be
you
a
have the
starting.
SMA charts? Because I follow
Yep.
all your retail charts. Okay, that definitely.
SMA is also on there, okay? It's dated
Okay.
5/1 of 2025
Okay, thanks.
Okay.
That was my second
So-
question.
That could be a starting point. I'm not saying that's perfect. That's a starting point.
Okay.
So take some people you're familiar with, or some managers you're familiar with. Maybe venture out, grab it, find out who's best at this and who's best at this. Every manager is going to say they're best at everything, so that's a challenge a little bit. But those would be some of my initial thoughts. Does that make sense?
Absolutely appreciate it. Very good. Thank you.
Perfect.
Steven, go ahead, man. What's your question? We got just under 3 minutes left.
Okay, thank you, Isaac. I appreciate all the assistance, Kurt. It was great training. My question: a customer has non-qualified money and is thinking, well, what are the advantages I might get by putting it into a variable or index-linked annuity and getting that temporary tax deferral versus going all into managed account?
Okay, so they're going to pay taxes on all the growth later. In managed accounts, I'm going to use SMAs and ETFs, which are tax friendlier than mutual funds. SMAs, you own the cost basis of the stock when you purchase it, versus in a mutual fund, you're going to get an inherited cost basis. They bought the stock a long time back. A way that sometimes happens with people is maybe there's a down year in the market, the client has less at the end of the year, and they still pay capital gains from the mutual fund because it bought them a zillion years ago. That's not fun to explain that. With the ETF models, ETFs don't typically pay capital gains. So therefore, when you sell the ETF down the road, you're going to pay the capital gain when you sell it, but long-term capital gains are taxed more favorably than ordinary income. And money coming out of the annuities you mentioned is taxed as ordinary income. So I'm not telling you the annuities are wrong. I'm telling you from my viewpoint, I'm not an annuity fan. Doesn't mean they're wrong. It just means that's my personal management philosophy. I could be wrong, who knows, right? But the tax advantage of ETFs and SMAs over mutual funds or over ordinary income coming from an annuity, those would be my thought processes. So I don't know if that answers your question or makes the water muddier.
No, that answers the question, right. I just wanted to get back to have something, concrete that I could show. We've already discussed that the income tax better in managed account versus the retail funds. So we could go on a very similar kind of philosophy of understanding the relationship between annuities and then the managed accounts. That's all I was looking for, and you got it for me. Thank you.
All right. Yes, sir.
Breakout rooms are about to get closed. I saw a couple good questions in chat I wanted to ask. I could ask one, but we might get cut off.
Do all we can do.
Hey, when you say we teach concepts, not rate of return, how do you avoid losing the do-it-yourself or index fund investors?
Okay, so if they're a do-it-yourself or do everything on their own, right? So, hey, listen, Isaac, could I ask you a question?
Yeah.
What kind of car do you drive?
I drive a Camry, a Toyota.
Okay, so then I'm assuming when there's anything wrong, you can tear the engine apart and fix electronics all on your own?
Not a chance.
Oh, so you're saying it's complicated?
Yeah, it's pretty difficult. I don't know how to do that.
Okay, so with your portfolio, are you investing in small, mid, large, growth, value, blend, large cap, large value, small growth? Are you using bonds, taxable, hybrid, long-term? How are you investing your money?
I don't know. I just put it in an S&P 500 index fund because that's what Dave Ramsey told me to do.
Oh, okay. Okay, so is Dave Ramsey paying your bills also?
No.
Okay. Do you know when you go in an S&P 500 index fund, Isaac, you're guaranteed you can't beat the market?
I didn't know that. You got 10 seconds.
Yeah, because as low as the fees are, they lower the S&P by that much. So would you rather be in an active and managed portfolio and have a chance to beat the market, or be in an index fund and be guaranteed you can never beat the market?
They can sense that. They can sense that you're tied in. They can sense that you've bought in, you've sold out, everything we do and we offer, we do, right? And so does the system work? Absolutely.
Awesome. That's a great way to end it. So we wanted to be on time. Thank you guys for all of your awesome participation. Thank you so much for being authentic and not being afraid to tell us what's on your heart. We really appreciate it. This has been an awesome MPI. Thanks for having us, Brad.
Hey, great job, Michelle. You're the best Gen Zer out there.
Unbelievable job. That was incredible. And Michelle, we've all come to the conclusion that this is going to be a weekly show for you. Maybe bi-weekly, we'll let you get away with that. But I think you did a spectacular job there. And I know all the rooms, everybody's got FOMO about what they miss. That's why we're going to keep repeating this stuff over and over again, Eldon, so that people can plug in and you can get what you need when you need it and then go and apply it. Because I